Good morning, all of you. I'm Dr. Amrita Tiwari, Assistant Professor of the SIRT Bhopal, Sagar Institute of Technology. Today we discuss the unit third of the AFM, the ratio analysis. And with previous slides, we discussed the financial statements analysis. So we discuss here the ratio analysis. Why financial analysis importance? Lenders need for the carrying out the following: the technical appraisal, the comprehensive appraisal, the financial appraisal, and the economic appraisal, and the management appraisal. The ratio analysis, it is a method procedure by which the relationship of the variable in the financial statements are computed and presented. It is an important tools of the financial analysis. It is used to interpret the financial statements so that the strength and weakness of the firm's its current financial conditions can be determined. The ratios, the mathematical expressions that measures the relationship between two figures or the groups of figures which are related to each other are mutually interdependent. It can be expressed as a pure ratio percentage or as a rate. Word of caution: a ratio is not the end itself. They are only a means to get or know the financial position of an enterprise. The commuting ratios does not add any information to a bill figures. It is only the reveals the relationship is more meaningful way so as to the unable to draw the conclusions they forms. Steps: selection of relevant informations, comparative or calculation ratio, the interpretations, and the reporting. The utility of ratios. Accounting ratio is very useful in the assessment of the financial position and the profitability of the enterprise. And however, its utility lies the comparison of the ratio. The utility of the ratio. Comparison may be one of the following forms. For the same enterprises over the number of years, for the two enterprises in the same industries, for one enterprise against the industry as a whole, and the enterprise against the predetermined standard, for inter-segment comparison within the same organization. How the ratio expressed as a percentage, such as 25% or the 50%. For example, it is a profit is 25,000, the sales is 1 lakh. Then the net profit can be calculated is the 25 for the sales. And the proportions, the above figures may be expressed in terms of the relation between net profit to the sales as the 1:4. As a pure number times, the same can also express the alternatively way such as the sales is the 4 times of the net profit, or the profit is 1/4 of the sales. And the liabilities and assets, and the net worth, equity, owned fund, share capital, partner capital, paid up capital, and owner's capital reserve. And credit balance, P&L accounts, profit and loss accounts. And fixed assets, land, building, plant, and machineries. Original value less depreciation, net value or book value or the written down value. And the long-term liabilities, borrowed fund, and the long-term loans and bank institutes, and the debentures, bond, unsecured loans, fixed deposit, other long-term liability, non-current assets, and the investments is acquired shares and the securities, old stock, and old disputed books, debt, long-term security deposit. Other miscellaneous assets are not the current or fixed in nature. Current liabilities, bank working capital limited such as CC, OD bills, export credit, and the sundry trade creditors bill payable, short durations loan or deposit, expense the payable provisions against the various items. Current assets, cash and bank balance, marketable quotes, government or other securities. Book debt, sundry debtors, bill receivable, stocks, inventory, storage, and spares. And advance payment of the tax, prepaid expense, loan, and advance recoverable within a 12 month. And some important notes: liability have a credit balance, assets is the debit balance. Current liability as those the either becomes due payment or the sell fall due to for the payment within a 12 month from the date of balance sheet. and the current assets are those which undergo change in their shape from the within a 12 month, and these are also got the working capital or gross working capital. Net worth long term liabilities is long term source of funds. Current liabilities are as a short term source of funds, and the long term liabilities, short term liabilities is the outside liabilities, and the current liabilities are source terms use of funds. Some important notes: assets other than the current assets as a long-term use of funds. Installments of the term loan payable in the 12 month are taken as the current liability, only calculated the current ratios and the quick assets ratios. And the profit shall be become a part of the net worth, and under the head of the reverse, it is loss, it become a part of intangible assets. Investment in a secure government security treat and current only. These are the marketable due, and investments are in other securities are treated the current, they are quoted, and the investment allies associated sister units from the treated in the non-current assets. Bounce shares is issued by the capitalization of the general reserve as such do not affect the net worth with right issues change take place in the net worth and current ratio. Classifications of ratios, these are classifications of ratios, and the first is liquid ratio, and the second was capital structure ratio, and the profitability ratio, activity ratio. What is the liquidity ratio? These ratio analysis short-term financial positions of the firms indicate the ability of the firms to meet its short-term commitments out of the short-term resources. These are also solvency ratios. And the ratios which the firms is current as ratio and the liquidity ratios and quick assets ratio or asset test ratio. This is the formula of the current assets, the current assets upon current liabilities. Ideally, its current ratios is the 2:1. The current assets, the inventory of raw material, WIP is work in process, finished goods, storage of the separate, sundry debtors, receivable, short-term loans, deposit and advance, cash in hand, cash at bank, prepaid expense, become a reliable, and the marketable investment and short-term securities. Current liabilities, the sundry creditors, bill receipt payable, outstanding expense, unclaimed dividend, advance received, income received in advance, provisions for taxations, and the provisions for the dividend, installment for the loans payable within in the 12 month, and bank overdraft and cash credit. It is a quick asset ratio. It is a ratio between the quick current assets and the current liabilities. It is a formula of the quick assets upon the current liabilities. It is ideally is a 1:1 is a considerable. Quick assets is the current assets less prepaid expense and inventories. And the quick liabilities is the bank overdraft income received in advance. And the current ratios, is current assets upon the current liabilities, and net working capital is what? Surplus for the long-term sources, and over long-term uses alternately differs on the current assets and current liabilities. That's for the quick assets ratios and the current ratios. We discuss the next slides for the remaining ratios. Thank you.